guys. So coming up next is Greg Harmon, somebody whose work I've had a ton of respect for a long time. It's actually one of the presentations I've been looking forward to the most all day, simply because selfishly I'm here to learn. So Greg kind of incorporates certain tools and techniques that I don't necessarily incorporate in my practice. So I tried to this year be more selfish and bring in guys that can bring a different perspective and teach me things that I don't know, and Greg is certainly one of those. So Greg, thank you for being here.
Well, thanks for having me, JC, and thanks for putting the pressure on me now too. I got to teach you something today.
That won't be hard.
One quick question before I get started here. Is my presentation big enough on the screen there, or do I need to make it full screen?
Make it bigger. I see the ski slopes in the back, and I live 3 hours from Lake Tahoe, and we haven't gotten much snow yet, so I'm a little bit upset about that. So I'm trying to keep as much patience here. What's that?
Okay.
All right, so I see you loud and clear. Go ahead.
Okay, so today, JC and I talked about a couple of different things that I could talk about here. I do spend a lot of time using technical analysis to find stocks I want to trade and then trade options around them. And that was one option, but then we started talking a little bit more about how there's a field of technical tools that's come about within the last 15 years, really, called harmonics and harmonic trading patterns that are probably not all that well understood. I use them. I don't profess to be the founder of them or to be the one and only expert on them, but I use them a lot as part of my process. So I told them I'd talk through this. I did include a couple of slides in here on what it is that I do. You can read through this stuff when you get the videos later on. Just wanted to let you know that I do have a special deal for people here today. As part of the subscription service, I also manage money for clients as well. If you have interest in that, give me an email. Now let's get into the real stuff. So why do we perform technical analysis? You've heard a lot of people talk to you about the charts today from a different perspective, from looking at relative value between different sectors, different stocks within the sectors, different types of ways of looking at that. You've seen individual stock charts as well. You'll see more of that going forward. And Tyler just got into a little bit of it in the past. Most of us as speculators look at technicals to find out which way the trend is going. Trend identification is the preeminent reason for looking at technicals at all. If you know what way the trend is moving, you can succeed, and you have a lot more possibility for succeeding in your venture. If you're trying to buck the trend, it's a lot harder than if you're trying to go with the trend. But a second area is looking for potential areas of reversal, looking for support and resistance areas, and those areas are where the trend changes. And when we can get into either a stock or a sector or an index or a country, when we see those inflection points actually happen, we can actually do a little bit better than some people that are not looking at that aspect. And the final piece is about that risk management. When you are already into trades, understanding where your risk lies and why it's at that level and why it's important at that level based on price history can be very helpful in mitigating losses and stopping trades at the proper levels instead of losing a ton of money on every trade or getting out too soon. But all those things put together really come down to why we perform technical analysis. It's to be prepared for the markets. So we're ready for what happens and what doesn't happen. I use several different toolkits within the technical world when I'm looking for opportunities. Those that know me know that I'm a top-down technician. So I'm looking for the major trend first, then I'm looking for sectors within the marketplace that follow that trend, and then I'm looking for stocks within those sectors, the strong sectors that are going to have the potential to outperform the index over short periods of time. The way that I look at the world then is, when I'm looking for those individual stocks, I'm looking for stocks that have a mosaic of technical indicators pointing all in the same direction. My thought process around that is that it's nice to have a head and shoulders pattern breaking down, but it's nicer to know that that head and shoulders pattern breaking down is also followed by a reversal pattern, as indicated by Japanese candlesticks, momentum falling, and Fibonacci retracement levels down much further than where the stock is. The translation there is, when you've got multiple aspects of technical analysis all pointing into the same direction, you have a lot better chance of success. So my toolkit is broken up into 4 different types of techniques that I look at. So I'll look at a chart and I'll look at the classical techniques. These are the things like you read about in Edwards and McGee. So head and shoulders, triangles, flags, support and resistance, those types of things. I'll always use Japanese candlesticks in my charts as opposed to tick charts to give an indication of intraday flow so that I can see that there's potential for reversals based on that type of activity as well. I use price derivatives, but I use them kind of sparingly. I use a couple of momentum indicators that you'll see on a couple of these charts, mostly just plain old simple RSI and MACD. And volatility, the only volatility indicator I use is Bollinger Bands. But I think that just understanding where people are looking in those price derivative areas is useful. And I say price derivatives because it's using the price data to create other indicators. The last piece that I've put on here, derived and quantitative techniques, are ones that you heard a little bit about earlier today. These include, for me at least, Fibonacci retracements and extensions, Elliott wave principles, and harmonic patterns. I know, I forget who it was, but I know someone went through a lot of the Elliott wave earlier today. That along with harmonic patterns, both really rely on Fibonacci retracements and extensions. So just to make sure that we're on the same page, I want to talk a little bit about the Fibonacci retracements and extensions, then get into some of the specifics on how that gets into harmonic patterns. And then we'll just leave this presentation completely, and I'll pull up my charting package and we'll take a look at some live examples that I see out there today and talk about how you might look to trade them. So Fibonacci's, I'm not going to go through the whole rabbit story in developing the sequence. If you're a trader and you're interested in Fibonacci's, you know what the golden ratio is, pi, 1.618. You know that it's an important ratio for an extension. You know that the inverse of that, 0.618, is another one. The complement, 0.382. And the symmetrical and full retrace values, as well as extensions using those same decimals, are all important to the process of trading with Fibonacci's. So to make sure we're on the same page, I've put this chart of the apple up here. And you can see from 2009 low up to the 2012 high, measuring that range, we saw that the stock then came back and retraced 50% of the move, almost exactly, before it started off again in 2013 and ran to another high in 2015. And following that high, it came back and pulled back and retraced 50% of the move again. So Fibonacci levels and these important retracement levels do play a role in the real world, and they do today, not just a long time ago. On that same chart, if you look at the extension side, that run from 2009 up to the high in 2012, with the pullback then in place and a further second leg up. The second leg up ended up being almost an exact 1.382 extension of the first move higher. So it works and still works on the extension side as well. This is what I'm talking about when I talk about retracements and extensions. When we look at this associated with harmonic patterns, there's 8 patterns that you can look for in a chart. And I've got them labeled here: the bat, the Gartley, the crab, the deep crab, the butterfly, the shark, the 3 drives, and the 5-0. All sound pretty cool. None of them actually look like bats, or, well, the bat looks like a bat, but the rest of them don't really look like anything like they're supposed to, how they're described. They do all have some commonality, though. Now, one of the first things to look for in all of these patterns is that they all contain an AB equals CD pattern. And I've got an illustration of that in the next slide for a second, just to make sure that we're all talking about the same thing. And as I stated earlier, all are combinations of Fibonacci ratios and extensions. One of the most easily recognizable things visually about harmonic patterns is that 7 out of the 8 labeled above are distinguished by a messy looking W in the chart. The one that doesn't is the 3 drives. And the 3 drives itself looks a lot more like an Elliott impulse wave, the 5 waves higher. We're going to look at harmonics today from more of a practical perspective for the student that wants to get more involved and learn more about this. The guy that wrote the book on this, literally 3 volumes, Scott Carney. If you want to learn all the details behind this in more detail, look for his book, Harmonic Trading, Volume 1. So again, just to make sure that we're all on the same page, an ABCD pattern. This is a pattern of an advancement, of partial retracement, and then a further advancement where the second advancement is equal to the first leg. So the concept here, AB equals CD, is basically just that the length from A to B equals the length from C to D. And I've shown it here in the chart of Amazon over the last few months as something that you could take a look at in terms of the potential for this might be a near-term top for Amazon before another pullback. But to be clear on AB equals CD, the CD leg can always extend beyond as well. So it's always possible for the CD leg to be not just 1 times the AB leg, but a Fibonacci ratio of that leg. So something like 1.382 times the CD, or 1.68 times the CD, or 2.0 times the CD. The other interesting thing and important thing to think about with the AB equals CD pattern is that it's one of the few that give you not only an estimate of potential magnitude going forward. So you can imagine back in, let's say, mid-January, when this pattern was confirmed first with the price movement over the B label. At that point, you didn't know how high this was going to go. But you do have then, with the move over B, a estimate then of the magnitude of the range by looking at the completion of what an AB equals CD pattern would give you. And it's one of the few patterns that also gives you an estimate on the time of that move. It's not always going to be accurate, but it does give you a flair for how long it could take for the CD leg to form. My personal experience is that I found that if the timing is not close, it tends to be that the CD leg is shorter than the AB leg. You can see with this one that it would be difficult for it to be shorter. It was such a fast move up on the AB leg. Okay, so we're all on the same page now with AB equals CD, with Fibonacci. Let me toss some more Fibonacci ratios and extensions at you now. The traditional ones we've talked about already, 0.382, 0.5, 0.618, 1.0, and then the extensions. Harmonic trading sees that there are other important ratios, and I've listed them here. Two of the most important ones for harmonics are 0.786 and 0.886. And the 0.786 is just the square root of 0.618, and 0.886 is the cube root of 0.618, so also the square root of 0.786. 1.13 and 1.27 as extensions are the reciprocals of those. So we add those extra four values to our battery of traditional harmonic ratios and extensions. The specific patterns within harmonic patterns all fit the same general band of having a point lead into the AB equals CD pattern. So we start talking about that the initial point that leads into the AB equals CD pattern as X. And what distinguishes one pattern from another is where the B and C points are. So I know this is getting kind of confusing. So let's start to look at this for one of the specific patterns. The first pattern to talk about is called a bat. And for a bat, we've got the, does my cursor show up here? Yeah. So for the bullish bat, we've got the X leading into A, back to B, back to C, and to D before a reversal from the down move higher. Hence why it's called a bullish bat. For the bat, we look at this retracement on A to B to be anywhere from, I don't know, I lifted this picture off the internet somewhere, and it's the best looking picture, but it's got the wrong numbers on it. This should be 382. So for a bat, the retracement of the AB leg from the XA leg should be between 0.382 and 0.5, or somewhere in that range. The retracement then for B to C should be 0.382 to 0.886. And then the final retracement C to D, so that D as a retracement of the initial XA leg should be right at 0.886 before a reversal happens. So you can think about this in terms of, here we've got a 5-point pattern, and at the end of this 5-point pattern, the harmonics are kicking in as to what might happen with it. Point D is called the potential reversal zone, or the PRZ as we call it. And it's potential reversal zone because this is like anything else in technical analysis. It's not a given that it's going to happen. The reversal is confirmed when at point D you see the print of a terminal price bar, and the terminal price bar is a price bar that goes through point D and then falls back below it, so that it has pierced through the D point and then shown confirmation of moving in the other direction. So one thing you might take away from just this initial view is that these patterns are not hardwired. They're fairly flexible. There's big ranges that the retracement ranges can fall into. So I find looking for the W, here's the W, is the first thing to look for, and then looking to measure to see what the B and the C legs are, to see if they fit within harmonic ranges is the best method to go about doing this. I also say that, you know, I talked about the bullish bat being a pattern that looks for a reversal to the bull side upon completion of the pattern. But there's two ways to trade this, actually. As this pattern starts to confirm in the CD leg when the price gets below B. So there's two things you can look at here. One is a trade in the CD leg looking for that move down to the 0.886 level. And the second way to look at it is as the reversal at the end of that. So there's two potential trades with every harmonic pattern once they're confirmed. Here's a real world example just from last week of the bat in real life using Lam Research. Lam Research reported earnings a couple of days ago. You can see that it had a long run higher, pulled back in the XA leg, moved up to point B, back down to point C, and as this bar printed, this is confirming a bat pattern and look for a target at the 0.886 level. And this chart here gives us a lot of things to look at in terms of the harmonic pattern. First, this one candlestick here, D, is a solid move up through the PRZ. We didn't get that confirmation of a move up and back down the next day, but we did get that terminal price candle on the third day where it started, moved up higher through here, and then fell back through the day. So this was the candle that gave you the confirmation of the pattern as a bearish reversal in the bat, or bearish reversal in the price. I've put the Fibonacci levels here on the end because this is an indication of what our price targets are for the reversal as it happens. And the first target for a reversal out of this is a move down, a retracement of 38.2% of the entire pattern, so from the X to A. And you can see that the same day that it confirmed the reversal, it gave you that full first target. But for harmonics as well, there are secondary targets. And if this 38.2% level does not hold and it continues, you start to look at the second target at 61.8% retracement. So for Lam Research here, we see the move there to 192.62 as potential in the short run. So with that, that's enough of the academics. Let's get out of this. Let JC look at the mountains again for a minute. And open up trading software. Okay, I'm going to have to resize some of these. So here's the same chart again using the live trading software from TradingView that I use. And if you're into harmonics, this is the software to use to chart out harmonic patterns. There may be other places, but today I have not found any other that's as good as this. So starting again, here's our Lam Research. And for the rest of the presentation I wanted to go through, I've got 5 more charts here that I wanted to talk through to show you other formations and to give a sense on how you might trade these. The next one is Xerox. Xerox is also a bat formation. And you can see here the fall down into the A place, the move up to B, down to C, and up to D again. Here we see that the first move through D ended up being a terminal price bar, and we got a pullback over the next 3 days of 38.2% before a bounce happened and it moved forward. This one I've labeled a perfect bat. Why did I label it a perfect bat? Because this retracement of the B leg is nearly exactly 50%, as well as the C leg retracement back from AB is also nearly exactly 50%. Just a special case that is intended to, it gets more respect in terms of being something that will reverse at 88.6. So when it's a perfect bat at 50 and 50, there's a greater expectation of this 88.6% level being a retracement. Once this reversal happens here, then at the target breakdown, the price is free to move back in any direction. The pattern's done at that point. Another one that's still building is in Cullen/Frost Bankers. And here you can see what I've labeled a deep crab. A deep crab is distinguished by this AB retracement being very deep into the XA leg. So where a bat retraces either between 38 and 50%, a crab can trade anywhere between 38 and 88.7%. But when it gets to the 88.7%, we call it a deep crab. We also see that the retracement down from B to C was a very deep move as well. The distinguishing factor about a deep crab is that it calls for the CD leg to be a 1.618 extension of the XA, so that there's a potential for a very large move higher once this pattern confirms with a move above point B here. And we can see that in Cullen/Frost, this has been extending, and we're getting close to that PRZ, the potential reversal zone here at 110. I don't think I have a crab as an illustration, but the difference between a deep crab and a crab is, number one, this 88.6% retracement on the XA leg is defined for the deep crab, and as well the 1.618 retracement on the CD leg. For a regular crab, it would look for an 88.6% retracement, so somewhere in this range, which kind of leads into the view that a harmonic pattern that has this retracement in here somewhere between 38% and 88%, almost always being considered a crab pattern to begin with, until it gets above the 88.6 level, and then it would morph into a deep crab. So you could look at a crab as having two targets on the CD leg. One would be at the 88.6 level, and if it continues beyond that, then look at it as a deep crab to 1.618%.
Greg, I think Greg, can you hear me? Yeah, the big question for me is, at what point do you say to yourself, okay, that's a crab, or that's a bat? You know what I mean? Like, at what point do these targets and things like that actually play a role in your decision making, and at what points do they not?
Here's kind of what I'm trying to describe. Up until this point, we've had price movement to the upside in Cullen/Frost, and a retracement back to the 200-day level. A move back up that is not quite as big. A move back down, and as it starts to move back up, first thing is I start to recognize a W forming. So I'm interested now, but I'm looking for the W to get above this point B to trigger the pattern. So on a move here above 102, this triggered the deep crab pattern and gives it the target to the upside here. Now, were we to see this get above the D point and fall back down, I put the Fibonacci's on here. So that would be the first thing to look for, JC, is the potential for the extension of the pattern to complete to the upside. And then on a move up through 110 and a fall back down, so confirmed move up above and then back down as a reversal, I would then look at this as a potential trade back down to 103 and perhaps as far as 99.
And then with respects to how you then execute your trade using options, a lot of that is explained in the book, right? Do you want to mention that?
Yeah, I wrote a book called Trading Options. I talk about how I use options after I've done the whole technical overlay, be it either Harmonics or some other technical analysis type tools to use. But generally we'll look for then these important price levels to come in terms of setting up what I call a driver option, so the option that I want to own. In this case, for upside from here, I would say I want to own something like 107 or 108 calls, and recognizing that there's potential for this to stall out at 110, I might then add funding options to these. Funding options are just options that I would sell to reduce the cost of the driver option that I want to own. So I might want to buy the 107 call, but I might want to sell the 111 call to lower the cost, even though I'm giving up room to the upside, because it's got some possibility of this pattern. And conversely, then on the downside, on a move through 110 and then back lower, I might want to own 109 or 110 puts, and I might sell 103 puts, or even 103 puts and then 99 puts again against that to lower the cost of the trade. I've got a couple others here that I think are kind of interesting. They illustrate some more that are happening today, and I'm seeing a lot more of. One of these is a bullish shark. The shark is distinguished where the C point is actually above the A point, and it has to be somewhere between 1.13% and 1.618. And that looks for this XA move in, the retracement, the move back up, and the move back down. It looks for a target to move back down to 88.6% of the full pattern of the XA leg, so down to about 43. But the shark also has a secondary extension where it can go to 113% as well and still be a trigger point for a reversal to the upside. So somewhere around 36.5. The shark is out there a lot in patterns that I'm seeing lately. So it's a good one to keep an eye on. It's one of the secondary patterns that Scott discovered. It's not one of the initial ones that he brought out. And again, it's a W, but it's distinguished by the right-hand side of the W being below the left-hand side. Another one I know has been talked about a lot recently, today, is the dollar. I wrote up something about the dollar index in deep view of that about 2 weeks ago, and then more about it last week as it started to break down further. This is a monthly chart of the dollar index, and you can see that this one has one of those shark patterns in it where it's got an extended C leg there, and calls for at least a move down to about 81.50 to complete the pattern. And as I said in the last slide, down to 113 retracement would give it something like new 7 or 8 year lows. So where previous guests and speakers on here have talked about the weakness in the dollar and looking for it to persist, Harmonics agrees with that as well. And the last one I want to talk about illustrates another point about Harmonics. Here's Gilead Sciences. So here's one that's been a darling of the fundamental community for quite a while, and then just kind of lost its way, starting to move back higher. We see that it is just as a Friday, completing a crab pattern. We see here the 0.43% not being exactly 382 or exactly 5.5, so we're going to call it a crab. going through the PRZ here, and if we saw a reversal back on Monday, we would look to short this either through options or by selling the stock short.
Hey, Greg, can you walk through how you actually draw those lines and at what point you start, at what point you begin? I realize that it's from like high to lows, right? But is there a time factor?
I'm just about to get that to illustrate one concept here as well. One of the concepts with harmonic patterns is that like any other concept in technical analysis is that it's not certain, it can fail. But there's one instance where technical harmonic patterns fail more often than not, and that's when this pattern is actually embedded in a deeper pattern. So let me clear this off of here. And we'll kill two birds with one stone here, showing how we decide to draw this. When I look at the longer view on Gilead, I'm looking at here we've got a run up to a peak and then a major reversal here. So I'm going to start here with the X, pull that down to the major bottom here and label that A. We've got a bounce here. We'll call that B. And you see, wow, that's like right at 38%. Back down here again, and we'll call this C. And this would then look for a move up to 88.6%. So somewhere in the 116 range. So if I just make this a different color just to keep it from being too confusing. We started at the major reversal pattern. We labeled the A at the next major reversal pattern and B at the bounce back from that. And that's how we're going to pick out the actual points here. And the concept here is that even though we've had this short-term view in Gilead, that it could have a major reversal here Monday and retrace 38.2%. The broader crab pattern that this smaller crab pattern is embedded within would suggest that the major trend is still up. So that you might want to, after this, if it does reverse, look for it to reverse only 38.2% and buy there, or expect that this pattern, the smaller pattern, might fail. We could probably talk like 2 whole days about harmonic patterns. You know, here we've gone through 1 or 2 of them. We didn't really talk through any of the history about this, but I thought it might be an interesting way to see some practical usage of these harmonic patterns in the current charts that are out there today as something a little bit different for part of the show today. So that's all I've got for you today. If you've got any questions, I'm happy to answer them.
I love that, Greg. I think you answered a lot of questions in and of itself, explaining what some of these different patterns are, because I don't really use them. So I thought that was really cool, just really for me. Let me ask you this. You mentioned earlier that there was one specific pattern that you've been seeing a lot of. Was it a shark?
Yeah, I've seen a lot of sharks on things that have pulled back lately. Bullish sharks are ones that look like they're going to reverse higher. Is
that in and of itself a signal? Like, do you consider that kind of like a breath indicator, for example? The fact that you're seeing a lot of them?
I don't look at it that way, but I do. What I have noticed is that if you see a couple of sharks, you tend to see mostly sharks in the marketplace. If you see a bunch of 3 drive patterns, there's a lot of them in the marketplace, and it really, I mean, it kind of makes sense in terms of looking at the broad view on this. I mean, if you look at, okay, from a high to a lower high to a higher low, stocks tend to move that way, right? If they're all following the trends, and the majority of them are going to be following the trends, you're going to see where there's higher highs in the market or higher highs in a sector, that most of the stocks in that sector are going to have higher highs followed by higher lows, and they're going to follow the index around.
Where can people contact you, and where can people get more of your work?
Yeah, you can contact me at dragonflycap.com. You can see my work at dragonflycap.com. you can contact me at greg@dragonflycap.com. I think that's on this one of these first slides. Yeah, the money slide. I don't really want to pitch myself here as much as just show this as educational, but yeah, you can contact me, ask me questions, greg@dragonflycap.com. On Twitter, I'm at Harmon Greg, and I'm on StockTwits as well as at Harmon Greg.
Well, Bart, are you here? Are you there yet?
I'm here. JC, what's going down, dude?
Nothing. I wanted to see if you had any questions for Greg. I know you guys make similar observations, so I was wondering if you had any thoughts.
No, I listened in so fully, Greg. It was fantastic. And I think JC did a good job. I'm going to go a little bit more into some of the theory behind why some of these patterns work. And, you know, from that perspective, I think this will be a good 2 hours to let Greg and I kind of show the world how we look at it. And I thought it was fantastic. So, you know, no questions.